We spend a lot of time when we're thinking about our portfolio, how it's positioned, how to protect it in different scenarios. We spend a lot of time thinking about consensus positions in markets. One of the consensus positions that have been building up over many years now, which we think is probably underappreciated, is in credit markets. So when I say credit markets, be more specific, in corporate bond markets. So historically, there's been this perception that corporate bonds, investment-grade corporate bonds, are a pretty safe asset class and also a liquid asset class, meaning that you can trade in and out of them as you need to trade in and out of them. We still believe fundamentally they're a fairly safe asset class in the sense that default risk is low. We're late in the credit cycle and that's starting to increase a little bit, but not to a point where we're overly concerned about it. What we think is the bigger risk in this asset class is liquidity risk. So historically, it's been the case that this was a liquid asset class. After the financial crisis, there were significant changes in the way that banks and their balance sheets are regulated. The corporate bond market is a market that is completely reliant on banks to facilitate price transfer. It's not exchange traded, so you're completely reliant on the banks and using their own balance sheets in order to facilitate risk transfer. What's happened because of regulatory change is that banks are much less able to do that than they used to be. What that then means is that secondary market liquidity has deteriorated very, very materially since financial crisis. What we look at are metrics like the percentage of the market that turns over annually. Those numbers are currently lower than where they were at the worst points of the financial crisis. So that gives you an idea of how structurally impaired corporate bond liquidity is. Meanwhile, on the other side, on the investor side, you've had this sort of credit creep where as yields have gone lower, defensive fixed income portfolios have had to buy more and more credit in order to keep returns up. I think that is a very dangerous consensus trade right now. Add to that, you have increasingly exchange-traded vehicles like ETFs, which are liquid instruments themselves, but they invest in corporate bonds, which are increasingly less liquid. So you have this mismatch between the liquidity that the ETF promises to the investor versus the liquidity of the underlying asset class. Now, so far, it hasn't been a big problem because we've been in a bull market for credit. We've had huge inflows into credit funds. It's only if that starts to turn that this will get tested. And I think investors in that space may find that at the time when they most need liquidity, it may not be there.